There is an explosion of new ETFs this year, close to 500, and the business of creating ETFs is exploding as well. Let's talk to two experts in this field, old friends of mine. Chris Hempstead is head of ETF and AP Portfolio Rebalance Trading at Mirae Asset Securities. Todd Rosenbluth is head of research at Verify. Chris, 500 new ETFs this year, $1 trillion in inflows, $10 trillion assets under management. What sticks out to you in this remarkable year? 500 new ETFs.
It's 500, and now since I probably gave you that stat, it's 580 ETFs this year. Obviously, the biggest headline of that launch, of those launches, was the advent of Bitcoin and crypto ETFs. That's dominating the growth in new assets. So $1 trillion, I think, overall to bring assets over 10 trillion this year in total AUM. But a lot of the growth in the new assets that came to market in ETFs is in the crypto space. But I think the most exciting thing we're seeing is new entrants come to market. Names that are not, your traditional BlackRock, Invesco, State Street, ETF players who've been around for a long time. But we're starting to see
some new players,
big players that have been on the sidelines for a long time coming to market and converting funds into ETFs.
I want to talk to you a little bit about that, but I want to get your thoughts, Todd, on this remarkable year. I mean, let's not overplay this. The biggest amount of AUM is still going into plain vanilla index funds. And for example, technology ETFs are still getting plain vanilla technology ETFs like the S&P, the XLK, the S&P technology ETF, still getting the big inflows at this point.
They are. So index-based products still dominate. In fact, the Vanguard 500 index ETF has already set a record for the most inflows for the year. We have had already a record for fixed income ETFs gathered thus far this year. We're likely, as you showed, to have it close to $1 trillion, which would be a record, passing the $910 billion that we had. Actively managed ETFs have really been punching above their weight this year, both in product development as well as the assets. It's been roughly a third consistently that we're seeing in actively managed ETFs this year. So really strong year across the board as ETF adoption continues. I
know I was asking you to both of you to pick ETFs that stood out. And Todd, one of your favorite picks for active management this year is the iShares Equity Factor Rotation ETF. The symbol is DYNF. And folks, if you don't know this, this is an actively managed ETF that's been outperforming the S&P 500. That's the bogey there. Tell us about that.
That's right. So it's outperformed this year. It's outperformed over a 3-year track record as well. This is a BlackRock ETF that had almost no money as it started the year. BlackRock added it to its model portfolios that many advisors use, shifting into more active strategies, and then it's continued to gather new money. It's close to a $10 billion ETF. Almost all of that has come in this year, and for good reason, as you mentioned. It's outperforming, so it shows you can have a core U.S. equity
It's been
strategy.
Outperforming, but I noticed in 2022 it underperformed. So in down years it tends to, I don't know what exactly the strategy here is, or it's a momentum strategy, or whatever it's doing.
So it's using the individual factors, so momentum being one of them, and value and quality and low volatility and size, and rotating within those. So yes, it's actively managed, so it isn't going to outperform in every year. Active management struggles from time to time, but over the 3-year time period, this ETF has performed well. And what really caught our eye is just the investor adoption has continued throughout 2024. It was not just a BlackRock model move.
But there has been some outflows, though. I mean, I look at, with oil down, for example, energy has been seeing outflows. And I see, of course, very little interest in two big sectors we used to talk about all the time, thematic tech and ESG. Still nothing, I keep waiting for ESG to make a comeback, but nothing.
I think there's a lot of definitions that need to still be determined. People like the idea of ESG. They like the idea of thematics. The thing is, Bob, when you think about a 60-40 portfolio at its core, that doesn't mean you go 60% into thematics. The thematic sleeve, if you look at the $10 trillion asset base in ETFs, I think it's properly positioned right now. And then it gives individuals like the three of us and anyone that we know who invests the ability to have an opinion. I want to be overweight clean energy. I want to be, overweight some thematic energy sector, whatever it might be. It's a really, it's a real segment of the market that I think has room for growth as the overall pie of ETFs grow. But I don't think you're going to see thematics replace the core holdings in a 60-40 basic portfolio.
The problem with thematic tech, but if you're not wondering what we're talking about here, it's essentially things like cybersecurity, for example. pieces of the tech world,
Infrastructure.
you tend to buy these things at the top when they're exciting. 7 years ago, cybersecurity was a hot thing, and people were buying cybersecurity stocks and putting together ETFs around them, and so it tends to push the price up, and the most amount of enthusiasm is buying right there at the top. This is an eternal problem with ETFs. It's a popularity contest.
Investors in thematics, I think the investors in thematics, if you want to think of them as active managers, if they are, the ones that are going to have the most success are the ones with a long vision and a long time horizon. The ones who are trying to time the market and get in cheap and sell it at the top are probably going to get hurt more than they win. Long-term investors with good vision get into thematics, and they tend to win overall.
Let's talk about things that are growing this year that are different. So first, continuation of buffer products, for example.
Unbelievable.
That seems to be amazing. We've seen this, I was talking to you about this, Chris, this uptake on single security leverage products. MicroStrategy has 3 funds that are out, ETFs levered to them. And then we have the S&P 500 without the Magnificent 7, XMAG, that's brand new as well here. So I see buffer products, single security leverage products, like several stuff around MicroStrategy, S&P X Magnificent 7, all sorts of innovation.
There's a lot of innovation, there's a lot of creativity. Are they the most complex products in the world? No. Does it take a little more time to truly understand how a buffer product works? It does, but there's a lot of good material out there to help people understand.
I want to point this out, these MicroStrategy leveraged ETFs. What is it about MicroStrategy leverage? Why is there so much interest in leveraged ETFs around MicroStrategy?
I don't know.
And they get good volume. Who's doing this?
Look, there's at least, as you see, there's 3 issuers on the screen that have brought a product out to market that's a single security, pivot point, and they each have north of $500 million in them. The street likes it. I think some of the street likes volatility. People like things that move around a lot. That's more of the day trader environment, I think.
Obviously.
I don't know if we would recommend for grandma and grandpa to put their retirement money into these kind of things, but with the right advisor, I'm sure they could find a home for it. But I think a lot of the uptake here is in traders who like fast money, no pun intended.
And they're not cheap either, so they're obviously profitable. Isn't that the real answer? There's enough people who are interested in trading this stuff. Obviously, this is
it would be very hard to make these products with a cheap management fee just because of the nature of how they're managed. They're managed with swap exposure and other derivatives.
Right. So how do you get like 2 times short or 2 times long MicroStrategy? It's a swap, right?
Yeah, basically,
explain how that works.
Most of them use swap, and what they do is they engage with a swap counterparty to provide them the daily return.
So is it the swap counterparty that actually has it on their books?
Correct.
They're the one that does, not the ETF doesn't have it on the books. So they're in a swap agreement.
The swap counterparty holds the securities that afford the ETF the leverage that they need. In doing that, it absorbs balance sheet at the swap counterparty, and with interest rates where they are, balance sheet's not cheap. And so
it's the counterparty that's charging a lot of money because they're the ones that have on their books.
Correct. The ETF manager is essentially renting the balance sheet of the swap counterparty to get the exposure. And the cost of rent for balance sheet right now is higher than it has been in the last,
Well, that makes sense to me
years.
then. I don't know what the fee is for those, but we've seen ProShares. They do very well for their
ProShares and Direction.
90 basis points sometimes.
And they've been doing it for a really long time, and they've got the lion's share of leveraged assets. But they also have an audience of counterparties that include the largest global banks in the world. The new entrants to the leverage market may not have those deep relationships with the largest banks. They will eventually. So it's just a matter of time.
So you go ahead.
I was going to say, so that's this fear and greed obviously tied to investing. That's the greed part of it, these leverage and these risk-on strategies. The options-based ETF world also includes what you were talking about that are defined outcome or buffered or protection-oriented ETFs. So Calamos has launched this year a suite of 100% downside protection-oriented ETFs. So you can participate in the upside of the market to a cap and have downside protection. Just, again, a great sign of the innovation that Calamos and some of the others in the industry have brought forward.